Hey everyone, hopefully you're having a good day. My name's Andy. My channel is Finding Value. I've got some quotes I'm going to go over. I'll give you my financial opinion on those quotes. There are a lot of things that I've learned over my investing, life, so to speak. And I'd like to share both the quote and my experiences with everyone on kind of the strategies I've adopted and my mindset that I've adopted over the investing over the years. So I've got a lot of Peter Lynch, Warren Buffett type quotes. These guys are some of the best all-time investors, and they do tie in with a lot of the stuff that I've got on the channel. So let's talk a little bit about these quotes. I'll give you some experiences and my opinions on it and what I have adopted and changed in my investing over the years. So I'm going to start here. This is Peter Lynch. And he says, far more money has been lost by investors preparing for corrections or trying to anticipate corrections than has been lost in the corrections themselves. And corrections are, known as recessions. They could be small corrections in the market, 10, 20% corrections or larger. And what Peter has done is basically not worry himself about corrections. What he does is he rides through them. And if you listen to me, what I try to do is I try to get the big market conditions right, the big picture right. And then what happens is I ride through all of the little stuff, all of the corrections. There could be a possible recession. People are so worried about that. And I tell everyone I'm going to ride through it. I'm not going to try to time every single small little movement in the market, because those are the least statistical probability wise, the least reliable market signals are these short-term chart patterns. I try to find the big trend. I find the big chart pattern break. I find the market conditions using ratios, using real estate and inflation, and all of that data. And that's where I try to live. I look at the market balances, the fundamental market balances of the market, and I'm going to ride it until those balances are corrected in the markets. And I'm very much, focused on the commodity bull market that's coming ahead of us. And these guys were very much focused on companies that controlled their selling price. So it's a little bit different, and I understand their viewpoints. I'm just so drawn to the commodities sector because decades can happen in years in terms of returns. What I mean by that is you can get 100 times your money in less than 10 years. That is a possibility. Doesn't mean you'll get it, but it's a possibility. And you could even do 1,000x. There's been companies in uranium and other sectors, natural gas, that have done many hundred baggers or even up to 1,000 times your money if you had the courage to buy at the complete bottom. But I'm riding the big trend. I'm not trying to time these small corrections. And Peter Lynch is saying, hey, look, you're going to lose more money trying to time these corrections than just riding through it. He says you get recessions. You have stock market declines. If you don't understand that's going to happen, then you're not ready. You won't do well in the markets, Peter Lynch. And I'm focusing more on the recession because a lot of people are thinking that we have a potential recession ahead of us, and they're afraid. They don't want to be invested. They want to be out of the markets. And what I'm doing is I'm going to say, I don't care. The trend has changed for commodities to outperform stocks. And I'm going to stay and stick with that trend, even if we could potentially go through a recession. And we had a recession in 2001, the beginning of that commodity bull market, and it did draw it down some. And I've talked a lot on the channel about the interaction between commodities and stocks and what that looks like, and how I didn't know exactly if we were going to get a huge pullback, if we weren't. And what I do is I offload all of those worries and say, you know what, I'm just going to ride through it. I'm going to buy the dips. So that is my strategy. It's a strategy that I developed early in this market. And I said, I'm going to ride through it because the overall glaring trend of the next decade, in my opinion, is commodities. And we know that the fundamentals, the market balances are all jacked up. So why should I worry about a recession if I know that the market balances are all jacked up in a lot of these commodities in the 2020s. Why try to time the short-term movements? And what he's saying is, expect some market declines, expect a potential recession. And a recession doesn't last very long. They're usually pretty short in duration. And I just view it as a better buying opportunity. It says your ultimate success or failure will depend on your ability to ignore the worries of the world long enough to allow your investments to succeed. So what he is saying in all of these is he's saying, you know what? You don't want to market time these market drawdowns or pullbacks. Recessions are going to happen. It's better to ride through it. And your ultimate success is to ignore the worries of it and to give enough time, a decade or so, to allow your investments to succeed. And that's the strategy that I basically built, is built not just off of logic, but off of the recommendations and basically these guys who are all-time best investors. It's based off of what they think is successful. And I'm doing and implementing exactly what they're doing to some extent. When I say to some extent, it's not verbatim because these guys are mainly in companies that control their selling prices. I'm applying it to commodities and the big picture view. That's your PPI to CPI ratio and your other ratios that tell you the market conditions. The market conditions determines the pricing of assets. They determine what those ratios will eventually be. They're going to determine what the pricing of these assets will be based off of inflation, interest rates, and all these other things. And also the imbalances in the market in terms of supply and demand. All of those kind of balled up together form an outlook of the next decade. And I'm implementing exactly what these guys are doing. Here's another one. It says, often there's no correlation between the success of a company's operations and the success of its stock over a few months or even a few years. And this is what a lot of people miss here. They say, well, the company's doing good. They're earning more money. How come their stock isn't going up? Because in the short term, it doesn't mean that the sentiment on that company has turned around yet. But he says in the long term, there's a 100% correlation between the success of the company and the success of its stock. This disparity is the key to making money. It pays to be patient and to own successful companies. And what I'm doing, even with the website, is I'm identifying where those discrepancies are in the market. The discrepancies are over the short term, but in the long term, they do correlate. I'm finding cash flow pigs that are unloved in energy service companies, in shipping. And what's happening is, I think that the market conditions going forward are going to reprice these stocks differently, but it requires patience. I'm looking for the disparity in the markets, finding that value, hence the name of the channel, and piling into those things. Because the market conditions will reprice the assets. That is investing. It says the key to making money in stocks is to not get scared out of them. Another one from Peter Lynch. And a lot of people, they get so scared, they got to sell out. They're scared to hold them. And what I'm doing is I'm allowing my stocks to float and move, and I buy on the pullbacks. It's all in my strategy. The key to making money is to not get scared out of them. And you got to focus on the fundamentals. You got to focus on the disparity in the short term. That is the opportunity. And to buy when things are low. In the business world, the rearview mirror is always clearer than the windshield. And what he's saying is, it's always easy to look at the balance sheets in the rearview mirror. A lot of people ask me, well, what about this balance sheet? You can't look at that necessarily, especially in commodity companies. Their balance sheets change dramatically. What I'm doing is I'm looking forward into the future. I'm looking at the energy crisis. I'm positioning my chess board. I may sacrifice a pawn or two to win the game. That is what I'm looking for. I'm looking at that windshield saying, hey, look, we've got an energy crisis. We've got a commodity boom that isn't going to be, a demand that can't be satisfied through the supply and copper and these other materials. I am positioning for that in the windshield. I'm positioning for the future balance sheets of these companies that we can't see looking backwards. That is the value, is to say, hey, look, if we are at $120 a barrel, what will these balance sheets look like? And we've gone up there with some of these oil companies and energy service companies. Their balance sheets are going to change dramatically. And looking in the rearview mirror, they look kind of dirty right now. But if you look forward and what I'm seeing in terms of market conditions, I think they're going to be repriced completely differently. It says investing should be more like watching paint dry or watching grass grow. If you want excitement, take $800 and go to Las Vegas. Paul Samuelson. So what that is basically saying is I call it a very long plane ride. You just got to wait to get to your destination. It's a very long plane ride, and it's very boring. And that's exactly what he's talking about. It's investments. It's not for excitement. It's for making money. It's for setting yourself up for a future. It's not about, putting all your money and getting an emotional roller coaster ride out of it. I mean, even though it is, to some extent, you gotta wait. You gotta be patient. The stock market is a device for transferring money from the impatient to the patient. So what these guys a lot of them are saying is, hey, look, you got to be patient. You got to wait for your potential buying opportunity. You wait for the charts to align. You buy in it, and then you got to be really patient. You got to be really patient for it to work. Sometimes it takes years. It says it's waiting that helps you as an investor. And a lot of people just can't stand to wait. If you didn't get the deferred gratification gene, you've got to work very hard to overcome that. That's Charlie Munger. Again, it's about patience. It's about getting in at a good opportunity and then waiting for that investment to be recognized by other investors. Again, I'm just going to say this. Prices change based off of differing market conditions, but those market conditions can change faster than what people can recognize. What we're doing is we're waiting for other people to recognize it and for that money to rotate over. And it's going to take patience. And if you notice, the best guys are ultra patient, the best investors. It says the single biggest advantage a value investor has is not IQ, it's patience and waiting. Waiting for the right pitch and waiting for many years for that right pitch. You're waiting for the right opportunity to come, and then taking advantage of that opportunity, and then waiting for your investment to appreciate. So we've got all this information here, and I focused it more on waiting, patience, and it's a trait that it needs to be learned and it needs to be practiced. There's a lot of investments out there that I'm in that haven't gone up massively yet. Some of them are shipping companies, but I'm holding on to them. And I know people, it's like they get so impatient. It's like, should we be in this? We need to go into something that goes up. It's like, guys, they're making money. They're printing money. Wait. Just wait. The market will recognize it. Just wait. And if they continue to print money, some of these companies, they are making massive amounts of money. I don't think they're going to dilute again. I think they are very well positioned for increased cash flows. The market will recognize it at some point. It just takes patience. And that's why we diversify. Some investments will go up quickly. Other ones will be delayed behind it. And that's good. We have a form of diversification. And I'm not diversifying just to diversify. It's just the way it is. And some of these will take off immediately. Some will be delayed. But overall, I think that the positioning here is actually quite good. And I think if we're patient enough, when the SPR, Strategic Petroleum Reserve release ends, we're going to see some increased oil prices, increased natural gas prices as Freeport LNG comes back online. We're going to get more interconnected natural gas prices to world pricing as more LNG terminals go up in Canada and in America. And we've positioned in some of these companies, I say we, the website that I share the positions that I'm in, and if people partake in it, they are interconnected to those liquefied natural gas terminals that are coming up. And I think that over time, the natural gas prices will go up to that. More of the international prices will come down. Henry Hub and Canada natural gas will go up. And I've positioned quite well for that play. So there's the disparity. Looking in the windshield out in the future, I'm positioning for that type of move, and the balance sheets looking in the rearview mirror will adjust accordingly. And we're seeing that adjustment. I'm going to go over a balance sheet and how it's changed over time with the Platinum members during a question and answer session. They wanted me to go over some. So I'm going to go over one of them. One of the companies, a natural gas company up in Canada, and I'll show them kind of a little bit of the difference of a year-over-year adjustment and how looking at a balance sheet looking backwards doesn't necessarily prepare you for what's coming ahead of us. But we can see the changes, and I can show people that. So that's what I've got for today. Hopefully you guys got at least some entertainment out of it at the least, or some good tricks and things to work on going forward as an investor. But if you guys like the content, give me a thumbs up, subscribe to the channel, subscribe to the website below, Platinum membership there, and we'll catch you next time. This is Finding Value.